Alrighty. So in today's video, I'm going to be sharing with you a simple yet highly profitable leap strategy that you can use on QQQ that's already generated me over 6 figures. So first of all, why did I decide to choose QQQ over the other index ETFs? Well, the reason is actually pretty simple. It's because in terms of performance, QQQ actually does the best amongst the other main major index ETFs. So for example, this is the QQ here, as you can see. Now I'm using Yahoo Finance, so you can definitely just go to Yahoo Finance and see this same page as well. So if you was to go to the performance tab over here on the left, and you go down to this trailing returns over here, you can see all the past returns in terms of the number of months and years. So if you will take a look at the 5-year return of the QQQ, you can see that the return is about 19.93%, which is pretty close to 20%, and the 10-year return is about 18.29%. So this is the average return over the past 10 years. So 18.29% is actually not too bad. Now, if I was to compare this to the other index ETFs, you will notice that this return is actually better. So if you was to compare this to SPY, as you can see over here, this is SPY. If you go to the 5-year return, you can see that the 5-year return is only 14.44%, and the 10-year return is 13%. So QQQ actually did better in terms of the performance compared to SPY. And what about for the other index ETFs? If I was to compare this to Russell, then you can see that the Russell really pales in comparison, right? As you can see over here, RWM, the past 5 years is 7.28%, and the past 10 years only 7.76%. So the QQQ really overshadows the RWM performance. And finally, the last of the few major index ETFs will be the Diamonds. So Diamonds is the Dow Jones Industrial Index. So if I was to go down here as well to see the returns, you can see that the 5-year returns about 10.39%, and the 10-year returns is 11.4%. So as you can see, out of all the major index ETFs, QQQ has the best performance. So that is why I want to use the LEAP strategy on QQQ. So this LEAP strategy, which I'm going to be sharing with you today, is a very simple one. And basically, it's a form of a stock replacement strategy. That means instead of buying QQQ outright, instead we buy and hold QQQ, we're going to sort of invest into the QQQ LEAPS, where we simulate a position of buy and hold. So how do we do that? So it's going to be a very, very simple strategy. So the strategy just involves 2 steps. So I'm just going to very quickly just show you the 2 steps that you need to do for this strategy. So the very first step is to just buy a dip in the money call LEAP that is about more than 1 year in terms of the DTE. So I want one that is very long dated. And the reason why I want one that is very long dated, because that's where the theta decay is not going to be as high compared to if you were to go for a lower DTE. So as you know, the theta decay is exponential. As it gets closer and closer to the expiration date, that's when the extrinsic value inside the call option, in this case the call LEAP, is going to start to decay very rapidly. So to reduce the effect of this decay, we want to go to very far out in terms of time. So that's why I choose roughly more than a year. And the second step basically is to just roll at around 60 to 90 DTE. And where do you roll it to? Basically, you just roll it back to step number 1. And all you got to do is just keep doing this. So the whole idea with this strategy is not to trade it in a sense where you're just trying to capture, profits here and there and hopefully try and avoid the losses when QQQ make a loss. So this is not that strategy. This strategy basically is to mimic the performance of QQQ, but using a leverage tool, which is options. So we're going to use the call LEAPS to kind of leverage the returns that we get on the QQQ. So what that means also is that if I was to go back to this table over here to see the annual total return, for example, if QQQ did 25.58% in 2024, what it means is that with LEAPS, you should generally get a higher return compared to this 25.5% if you do it the right way. Now, same thing for 2023. So if QQQ did 54.85% in 2023, with the LEAPS strategy, you can get a higher return. Now, one thing you need to know is that with this LEAPS strategy, you're actually enhancing the performance of the underlying. So in this case, if it's a positive, you enhance the positive return. But if it's a negative, for example, in 2022, you'll be enhancing the negative returns as well. That means to say your performance using LEAPS in 2022 will be worse than 32%. So that means you'll be down maybe more than 32%. So this is how the core LEAPS work, or rather this LEAPS strategy is meant to do. It just enhances the performance. So that is why for the LEAPS strategy, which we're using, you want to use it on positive drift vehicle where you know that in the long term, it will want to just keep going higher. If you use this on individual stocks, then the risk really is on you, because if the stock actually do not go up over the long term, it keeps going down, then you're going to lose a lot of money. All right, so the next thing that I want to talk about is this deep in the money call LEAP down here. So deep in the money, how deep do we want it to be? So when I talk about deep in the money, I'm really talking about somewhere around 90 deltas. And that is because when you are buying options, you have a very big enemy. You have a very big nemesis, and that is the extrinsic value. So when you are buying options, this extrinsic value down here is your kryptonite. Because as you can see over here, this is the delta of the options. So what you'll notice is that the higher the delta, the lower the extrinsic value. And the lower the delta, as you can see, as I go to the lower deltas, you will see the extrinsic value finally pick up. So this extrinsic value down here, this whole column here, what it just means is that whatever value you see here will go to zero once this option expires. So the whole idea down here is that when I buy the option, I want to have as little extrinsic value in the option as much as possible. Now, this is the opposite when you're selling options. When you're selling options, you want to have as much extrinsic value as much as possible. But when you're buying options, it's the opposite. So when you go for deep in the money, for example, 90 deltas down here, you can see that the extrinsic value is about $20.81. Now, if you were to compare this to something that's at the money, so let's say, for example, if I was to choose one down here, let's say 60 delta, you notice that it's $52.38. Now, for the option price itself, this is much cheaper, because if I was to buy this option, it's only $53 on the ask side. But if I was to buy the 90 delta option, you can see over here, it's going to cost you $164.47. So in terms of actual dollars, that's about $16,000 per option contract, because each contract controls 100 shares. So as you can see over here, let's say if the QQQ, after the end of the life of this option, so as you can see over here, I chose about 373 days. What that means is that if QQQ do not move from its current price, so as you can see, the current price is about 515 as of this recording. If it does not move from this price at expiration, what is the final value of this option? Well, the final value is basically what you purchased for minus off this extrinsic value down here, because extrinsic value goes to zero. But what remains is the intrinsic value. Intrinsic value does not decay. So in this event, whereby the market did not move at all you lost is $20.81 out of the $164.47 that you bought this call LEAP for. Now, what about the at the money option? The at the money option would be slightly different, because right now we had bought this one, which is out of the money, right? As you can see down here, this line down here denotes whether it's in the money or out of the money. So this option strike down here is out of the money, which means to say, once it reaches expiration, all this extrinsic value is all gone. And because QQQ did not move at all, or rather it went back to the same price at the end of this life of this expiration of this option, basically your option is now worthless. So you had paid $53 for it, now it's zero. So that is why whenever we are buying call LEAPS, we always want to go as deep in the money as much as possible. In my case, my comfort is to go very deep in the money. Now, some people have asked, Davis, can I go for not so deep in the money? Can I go for something like 80 delta? Can I go for something like 70 delta? Yes, you can, and there's always a trade-off, right? The trade-off is that firstly, it'll be cheaper to purchase the option, but you have a higher extrinsic value, which means to say your option is going to worth much less, especially if QQQ does not move at the end of expiration. And as you can see over here, same thing as well. You're going to lose $43 out of what you purchased of this $75. So the whole idea down here of going into this 90 deltas is to reduce the amount of the extrinsic value decay at expiration. Now let's get over to the second point. So the second point, okay, my drawing is all gone down here, but the second point down here is to roll once the DTE is roughly around 60 to 90 DTEs. So why do I say to roll at 60 to 90 DTEs? So first of all, rolling is just basically to continue the position. So remember, we are just trying to simulate a buy and hold of QQQ, but we're using LEAPS, right? We're using LEAPS options. And because options has a very finite date where it expires, we cannot just leave it all the way to expiration. We want to roll it to continue. So I choose 60 to 90 DTE because that's the time roughly where the theta decay starts to gradually increase even more. As you know, like I mentioned just now, theta decay is exponential. So towards the last 45 days, what you will find out is that the theta decay really decays very quickly. But if you go somewhere around 60 to 90 DTE, the decay is still acceptable. So we want to get out of this position and renew this position back to the original position again. That means you bring it back all the way to more than 1 year in terms of the expiration date. So now that I've shared with you this strategy, you might be curious, how would this strategy have done over the past few years? So how do we know whether this strategy has been doing well over the past few years? Well, the simple way is simply to just back test it, right? So first of all, you need to realize that this strategy makes sense because it is just riding on the coattails of the performance of QQQ, and it just enhances it. So at the end of the day, if QQQ keeps going up and QQQ itself is profitable, then it only makes sense that this strategy is profitable, provided you go according to the mechanics which I shared with you. That means deep in the money. If you were to go one that is at the money or even out the money, then maybe there could be some challenge because of the decay of the extrinsic value. So let's first start off by testing out how this strategy actually did over the past few years. So as you can see over here, this is the backtesting tool by Tasty Trade, and it's free to use. If you have an account with Tasty Trade, all you gotta do is go to the tab on the left hand side. So this is the web platform. Just have to click this icon over here that says backtesting, and it will bring you to this page over here. So for this, we're just going to choose a long call, and make sure you can see this is QQQ. And interval, I'm just going to test it for the past 12 months first, and then we will also see after that, the past few years before this. So over here, we are just only going to trade one contract continuously. So what is the results that you can get trading this strategy continuously just using one contract? So over here, as you know, the strike, we're going to go for about 90 deltas, and the expiration, we want to go at least 1 year out. So 1 year out, I'm just going to put 365 DTE because that just means the expiration date is 365 days away, which is about a year. Now, the whole idea down here is that we basically do not want to get in and out too many times, because if you get in and out so many times, firstly, you will incur the spread. And as you know, the spread for deep in the money options is not that good because the spread of the bid and ask is going to be pretty wide. So as much as possible, we want to reduce the transaction of this bid and ask. So we're only going to pretty much roll about once a year. So this is going to be a semi-passive strategy, right? At least slightly more active than a buy and hold, but definitely much more passive than the other selling option strategies that I have on my channel. So for this, I'll just put every day as default, but I'm going to limit the number of active trades. So as you can see, I'm going to limit it to 1 and exit a specific DTE. So I'm just going to put at 90 DTE. And the rest, I'm just going to not check this box down here, just leave it as it is. And then let's run the back test. And let's just see how it's going to perform for this 1 year. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So as you can see over here, the results are out, and based on the P&L, you can see that it's $7,064 based on one contract. Now, if you did a buy and hold, you can see that Tasty Trade backtesting tool, they actually compare it if you had purchased the shares of the underlying. So in this case, QQQ, buy and hold is $3,284. So the total P&L is actually more than double what you will get in buy and hold. And if we take a look at the return on the used capital, you can see that the return is 66.38%. And this again is more than double than what you would get if you buy and hold. So as you can see, this is what I mean. It enhances the performance of the underlying. So although it enhances the positive aspect of the return, it also enhances the drawdown. So this is one thing to really pay attention to as well. As you can see over here, the drawdown for this strategy is 33.3%. If you had buy and hold the QQQ, you will see that the drawdown is only 13.56%. And that means that the drawdown for buy and hold is less than half of what you will get with LEAPS. So like I mentioned, it magnifies, it enhances the performance. So this is something you really need to pay attention to. Although the return is higher, you also have a bigger drawdown. So in a sense, higher risk, higher reward, but not in terms of absolute dollar for the capital that you put in, but rather because the capital you put in is much smaller compared to if you actually buy and hold, because your LEAPS option is going to be cheaper. That is why your return is going to be magnified, right? Either to the upside or to the downside. So this is for 1 year return. Now let's take a look at the past 5 years return and see how it performs. So as you can see, the past 5 years, so this would actually go back to the pandemic time at 2020 and also to the 2022 bear market. So let's just see how this actually performs. So let's run a back test over here and just let this back test load. Okay, as you can see over here, the total profit and loss, again, it's much higher than if you do buy and hold, and the return is higher as well. Now, this time it's not as great as compared to 1 year return, which you just saw just now, but it's still higher, right? Because if you buy and hold, it's about 140%, but if you use LEAPS, it's 197%. Now, over here, another thing again to take note, you can see that the drawdown also is higher. Buy and hold, your drawdown is about 35.62%, but for LEAPS, is about 48.75%. So now let's go a little bit deeper and see the details of the transaction. So this is one of the beauty that this backtesting tool has, is that you can actually take a look at some of these details on this whole strategy for the past 5 years. So one thing you will note is that there are very few trades, and it's designed to be this way. As you can see, there are only 6 trades over the past 5 years. Because we put the DT as 365 and we exit somewhere around 90 DT, where we roll it to, the back to step 1 again, like I mentioned. So there's not many trades that we put on. And this is what we want as well, because again, this is meant to be a replacement for a buy and hold, but a leverage way of doing it. So you will see that there are 6 trades in total. 4 of them are in profit, and this one is in a loss, 2 in a loss. This one is in a slight loss. So what you notice is that this profits down here and the losses kind of already mimics the actual return of QQQ, because this loss down here is sustained actually during the bear market in 2022. Now 2020 is overall a positive because QQQ actually was positive in 2020. So if I was to go back to this table over here, you can see, right, in 2020, QQQ actually had a return of 48.62%, so it was positive. But 2022, it was a loss. So over the 5 years, basically you have 4 winning years and 1 losing year. And this is exactly the same with this strategy as well. Pretty much you have 4 winning years and 1 losing year. Now, there's one other thing that I need to point you out to when you're trading this LEAPS strategy, and that is that the capital, when you first put up into this strategy, you may need to top up when you actually roll it again if it's a loss. So let me just show you what I mean. So if you were to go to the logs tab over here, you will be able to see all the trades that was placed and what it was closed out for. So as you can see over here, the premium at this date, when you bought the 90 delta, it cost you about $5,850 to put this trade on. So on this trade itself, it was a profit of $5,731. So that means to say now your capital is this sum of these two amounts. So 5,800 plus 5,700, you have roughly over $11,000. Now out of the $11,000, for the next trade, you need to put up $8,800. As you can see over here. So 8,800, and then you make another 7,400. That makes the sum. And then the next one, you put this amount. Now, this is all good if you start off with winning years. That means most likely you do not even have to fork out additional capital to sustain this position when you roll. But what if the very first year which you put on is going to be a loss? For example, let's say the fourth trade happens to be the very first trade that you put on. All right, so let's just remove these first three trades, assuming it never happened. And your very first trade is that you paid $11,100 for this trade, for this call lips. Now, at the end of this trade, when you're about to roll, what you realize is that you're down about $9,000 over dollars, which means to say of this $11,000 which you put up, you only left roughly $2,000. But what you notice for the next trade when you roll, because now we need to roll back to the 90 deltas again, you need to have more capital this time. As you can see over here, it costs you $9,200 for you to put up this new position when you roll. But you already only have 2,000 left from this original 11,000 you put up because you lost about $9,000. So what that means is that your capital have left 2K. You need to top up roughly about $7,000 to put up this position. So do you see this is one of the cons of putting up this LEAPS strategy? So it's not like you put up one time and you think that based on this capital, you can always keep making more from there. It's not necessarily true, right? For buy and hold, probably so, because if you just pay the full amount for the share itself, if there's a drawdown, all you got to do is just hold on to it and you just wait for it to eventually go back up again. So there's no need for you to pump new capital into the trade. But because you're using LEAPS, LEAPS is a leverage tool. So this is where you might actually have to top up your capital if the first year is a loss. And let's say, for example, if you are a little bit unfortunate and you reach the point whereby there are multiple losses in a row. As you can see over here, this is 3 years of losses, which means to say you're going to have 3 losing trades. You need to top up each time whenever you roll to the step 1 again. So this is something very important to take note when you're trading the LEAPS strategy. Now, one last thing I want to touch on is what if you do not actually have enough capital to put on one of these 90 deltas call lip down here. As you can see, for this 90 delta call lip based off of 373 DTEs, it is going to cost you about $16,000 for you to put it on. And as you know, if this year, let's say for example, is going to be a loss, it means to say the next time you roll this, you need to add capital again. So what can you do if you don't have that big of a capital? Then this is where you might want to consider the cheaper version of QQQ. So the cheaper version of QQQ would be the index ETF called XLK. So XLK is also an index ETF, but the price is much smaller. So if I was to go to XLK over here, let me just remove all these drawings. And if we were to go all the way to the 373 days as well, you can see over here, one contract of the call lips at around 90 delta for XLK is around $8,250, which is around half of what you would have to fork out for QQQ. So if you have a smaller capital size, you can consider using XLK for this LEAPS strategy. Alright, so I hope you found this video helpful. If you have, please give me a thumbs up and also subscribe for more videos like this, and I'll see you in the next video.